What's up, my savvy homeowners and future homeowners? It's Tristan with the Pearrow Group here, and today I'm going to answer a question that I get from time to time that I think is really important general knowledge for people to have, and that is, what affects interest rate? Why would one get the interest rate that you get? So it's really a laundry list of things, to be honest, guys, but I'm going to go through it as quickly and as simply as I can. But it's not one simple thing. It's not just like, oh, here's the interest rate you get, okay? So obviously the first and most well-known, I'd say, thing is your credit score. The better your credit score, the more the lender or the bank is going to say, okay, this is a safe person to lend to, and that's going to have a more favorable effect on your interest rate. Now keep in mind, none of these things is going to be the end-all be-all, and they're all going to have fractional small impacts that collectively affect the rate. It's not like credit score is, the only factor or anything like that, okay? But credit score is definitely going to have an impact, and the better your credit score is, the better rate you're going to get. And when we talk about a good credit score, we're talking about credit scores that are 700 or above. Anything below 700 is really considered fair and is going to start to hit the rate more than if your credit score was over 700. Once you get to 800, your credit is pretty phenomenal. If you've got above an 830, leave a comment because I want to know how you did it. The next thing that is going to affect your interest rate is going to be the loan program. There are lots of types of loan programs out there. There's VA, there's FHA, there's USDA, there's conventional, there's all sorts of loan programs, jumbo. All these loan programs are going to carry a different set of interest rates, okay? So that is going to have a big effect on the rate. Then there is down payment. How much are you putting down if this is a purchase, or how much are you taking out if this is a refinance? That's absolutely going to have an effect on the interest rate. The higher that you're bringing that loan to value ratio, as we call it, or the amount versus how much the house is worth, right? The higher the interest rate is potentially going to be because you are pushing it as far as the risk of the loan in the eyes of the lender or the eyes of the bank. And you're going to start to see a theme here. A lot of this has to do with risk to the lender. The lender wants to make sure they're safe and that their money is accounted for when they give it out, right? So this is a way that they protect themselves. So what else? What else is going to affect your interest rate? Well, rate type is absolutely going to affect your interest rate. What is rate type? Well, there's really two rate types that are in existence, I guess you could say. And the first one is a fixed rate, which most people know about. It's the most common type of rate that is originated today in this market. And then there's an adjustable rate. Adjustable rates change and fixed rates don't change. It's pretty simple. So that's going to absolutely have an effect on the interest rate. And guys, I have a cheat sheet down here, so I'm going to look at it because I want to make sure that I don't miss anything, as this is a long list. Loan term, of course, loan term. So is it a 30-year loan? Is it a 15-year loan? That's going to have a big impact on the rate as well. Also, your debt to income ratio can have an impact. If things are being pushed towards the top end of what the bank likes as far as how much income you make versus how much debt you carry, that could have an impact on the interest rate as well. What else will definitely affect it is this going to be a primary residence that you're going to live in? Is this going to be a second home that you're going to vacation in? Or is this going to be a property that you're going to rent out? Because that will absolutely have a very big impact on the rate as well. And then there are some overarching things that impact interest rates as a whole. Obviously, the Fed, right? The Fed sets interest rates. And then the 10-year Treasury bond, the US 10-year Treasury bond, is actually what interest rates or mortgage interest rates are tied to, and they follow the fluctuation of the US 10-year Treasury bond. So if you would go look at what the Treasury bond was at during 2020, when everyone was refinancing and rates were really, really phenomenal, you'll see that it was much lower than what the Treasury bond is today, as rates are starting to push slightly back up. So I really hope that's informative for you guys. Now you have a little bit more of an idea about why interest rate is what it is. And guys, don't get too caught up on interest rate anyway. There are tons of ways that you can effectively reduce your interest rate without doing anything at all. So if you're curious about those, as always, reach out. I'm happy to answer questions and help. And thanks guys for listening, and I'll talk to you soon.